to the Morning Bell. I am Keith Harwood here for Yellow Tunnel and Tradespoon. Normal disclosures before we get started. Options involve substantial risk and are not suitable for all investors. Tradespoon, Yellow Tunnel, and myself are not investment advisors and not registered with the SEC or FINRA. If you do have questions about your own personal financial situation, please consult with a registered financial advisor. The information in this presentation is for education and information purposes only and should not be considered trade advice. And finally, myself and or the team at Tradespoon or Yellow Tunnel may have a financial interest in the securities presented or the trade ideas. So please keep that in mind as you evaluate anything that we discuss for your own personal investment or trading portfolio suitability. And with that, pretty flat start to the day. Got a handful of stocks moving a little bit here, but generally a pretty flat start to the day. Gold, silver getting hit this morning. In preparation for the Fed. This is what we're doing right now. We're just preparing for the Fed. So the Fed this afternoon is going to more than likely lower interest rates by 25 basis points. And once they do that, the real focal point seems to be on what the verbiage of their rate cut announcement is. What are they projecting? Do they set a true path for the rest of the year, or do they keep it very wishy-washy? The market likes confidence in what the Fed's going to do. And so having that confidence and knowing what they're going to do and how they're going to do it and everything else helps people set their goal. If we know what the weather is going to be, we know how to prepare for it. Whether it's going to be rainy or sunny, I need to know what to pack and how to dress and how to approach my day. If we just say we have no weather forecast, it's going to be who knows every given day, then I got to prepare for everything. And that creates that difficulty for the market to really set a tone, know what sectors to focus on, et cetera, et cetera. So this is really just putting some expectations in for the market, ideally, in order to set a tone for the rest of the year. And if it does so, as I hope they do, then this stuff gets a little bit less choppy, potentially. We don't like uncertainty. Uncertainty creates that desire to hedge, desire to reduce, desire to move away from good companies because something in the future may become a problem because of the Fed, because of tariffs, because of something else unforeseen. So reducing one of those unforeseen risks is generally considered a good thing for the market. Certainty helps lead to lower VIX, which helps lead to a higher market, which helps lead to lower VIX. And then we start getting into that potential for a grind high or bull market where we go up 0.1, 0.2% per day, and it's very predictable. Mario, I think the reason the gold and silver are going down ahead of the Fed is just because of how much they've run up ahead of it. So there's some profit taking here, some risk off. We had a lot of allocation into gold and silver over the last few weeks. And now that concern that they may reverse course leads to a manifestation of that concern. People start selling because they're worried it might start selling off, and then it does sell off, and then people say, oh my gosh, I got to get out before the Fed because something's going to be said that's going to create that sell-off. At the end of the day, we may see them right back to unchanged or up. Or maybe the Fed says something about not lowering interest rates as aggressively. Maybe they say that they're only looking for 2 this year. And that's the concern right now. I don't think that people are worried that the Fed's going to say 5 cuts this year, or 4 even right now. It doesn't seem to be in the cards. But that off chance that they say that they're not going to lower interest rates as aggressively as the market's currently pricing in may be part of the problem. Or that they say that inflation is no longer a concern. Well, then if people are using precious metals as an inflationary hedge, then they want to reduce that. So it's bigger than I think we would normally expect in silver, in particular, down about 1.5 standard deviations today. But it's a natural process, I think, to take a little bit of that win off ahead of time, just in case. And then we may unwind it today. And all of a sudden we see silver up, 60 cents or $1, or we see gold up a couple of dollars, GLD, not the futures. Futures maybe go up 20 or $30 or $50 or more. We'll see how it all kind of plays out. But right now, I think it's just a sort of natural risk reduction ahead of the announcement, not chasing through it. We had consolidated for a couple of days and now a little concerned that this may be the end of demand for now. And that's, I mean, I think that kind of goes back to that fight or flight response to a certain extent, where you've got some people that are just reducing positions. So it's a little flight, mini flight. I'll have to check volume, but I don't know if volume is large or if this is just you know, a minor blip in an otherwise bull market. I mean, we had a high RSI, very overbought. It's, you know, I think it's just kind of some of the natural. We're not bearish here in gold and silver as a result of the pullback this morning, but we've got profit taking. All right. So I think the key for today for most people is there stuff that I want to do ahead of the Fed? And what do I want to have on my watch list for once the Fed talks? If the Fed says something that is bullish market, where do I want to go? If the Fed said something that is bearish market, where do I want to go? If the Fed says something that is bullish precious metals, what do I want to do? If the Fed says something bearish precious metals, what do I want to do? And there's a whole universe of opportunities here and potential scenarios, whether it's driven by, you know, financials moving, growth stocks like tech moving, or, you know, the commodities-based stuff that's moving, or just something completely away from the U.S. market, you know, going into Taiwan with TSM and EWT, or going into China with Baidu, which is going up again today. It's, you know, never-ending run there. Going into South Korea with EWY. Going into Lyft is up a bunch today. That should have nothing to do with the Fed, right? So kind of evaluating some of these opportunities, what may be correlated to Fed, what may just be correlated to the market. So if the Fed creates a big move, everything kind of goes towards a higher correlation. So being prepared for any of these potential scenarios. And then just, you know, trade what we see, not what we expect. So there may be a little bit of a rationale to have some risk on ahead of the Fed, but I don't want to be maxed out because we have an input here. So if my trading thesis is built upon AI generated signals, technical signals, etc., the Fed's not a technical signal, that's a fundamental signal. So I don't want to be max risk when fundamentals are driving the market instead of technicals. I want to be max risk when there's no fundamental, all technical, all AI. Same way I don't want to have max directional risk on an earnings day, because I may have an expectation of bullish earnings, but that's more off of just maybe a feel or a fundamental analysis. And if I've done the fundamental analysis, certainly make the fundamental analysis based trade, but I don't want to use an AI signal to make a fundamental trade. So I don't want to think that, you know, if, let's say Micron, if Micron's getting a bunch of AI based signals heading into earnings, I believe it's next week, maybe 2 weeks away. Anyway, I'll double check that. But anyway, if Micron's earnings are going to be a new input, that can completely shift all the technicals, all the money flow and everything else if they disappoint. And if they beat somehow after the run that they've had and create a spike up, what's the real potential move that comes with that bull input? Are we going to deal with something more like Microsoft where it's a spike and fade? Or are we going to be dealing with something that spikes like Broadcom and then has some continuation coming afterwards? You know, that's all for the market to decide, I suppose. People with a lot of money determining where to get in, where to get out, and we're looking to go with the flow as that stuff happens. Try maybe to have something on just in case for psychological benefit, but there's not a huge expected value of being in trades for the Fed unless we can see a mispricing out there. Something that looks like it could have a 2-3 standard deviation move because it's highly driven by a fundamental input, but the market's only pricing in a half or a 1 standard deviation impact. That goes back to probability of success versus return on capital. As we've got a fundamental input, the probability of success for any directional trade goes back towards 50-50. The less certainty we have, the more coin flip that we end up with. We have a much greater chance of a negative input due to a fundamental input sorry, we do have may have a bull run going, but then when a fundamental info comes up, that can be the trigger point to stop a bull market on a technical. So we drive the probability of success down. Up, down, equal shot. So I have to find return on capital to make that trade. I have to focus on the return on capital focused trades. And if the return on capital is being priced up because we elevate implied volatility in the options market for that potential for a move, then maybe I just have a bunch of break-even expectation trades. And while they may feel good to win, they're going to feel bad to lose. And it's a little more of a gambling trading at that point, but sometimes that can, a little bit of gambling, as long as it's in near a zero or a positive expected value anyway, can work. And that goes down to like the 10% probability of success, but I can make 20 times my money. That's got a positive expected value because I can make 20 times my money 10% of the time. It's most likely not going to work, but if it happens, it feels good. And it did still have a positive expected value. So it was a justified trade. It's just not a trade that I put my whole capital into, because even if, the market's pricing in 10% chance and but I think it has a 20% chance, it's still more likely than not going to be a losing trade. So I don't want to load the boat on ideas that are more likely to lose, even if they have a positive expected value. And I don't want to load the boat on anything that's just built upon hope. Hope is not a trading strategy. Well, not a good trading strategy. It is a trading strategy that some people use, but it's not a good one usually. Those have negative expected value. All right. So broadly speaking, as we go into this announcement, what do we have right now? We have a bull market with some profit taking. We have expectations that the Fed's not going to do anything crazy. Otherwise, we'd be pulling back more right now. People are preparing for it by buying out of the money puts. Hope is a bad town in Texas. All right. I'll have to look up Hope, Texas, and see what their full story is. I haven't looked at them, but yes, Hope is not a long-term success trading strategy. But yeah, so what are we at right now? We have a market that is trading near the highs, consolidating near the highs, and people are taking off some risk by buying puts. So implied volatility is getting elevated ahead of the Fed. People want to have that participation to the upside that is happening. Psychologically, sometimes it can be difficult to be flat heading into the Fed and then see a 2% rally and not know whether to buy or not. That's one of the more difficult scenarios. It's a bullish input and the market prices it in. So is it already fully priced in? Is there more room to run in the next 24, 48 hours? Or do I need to now wait and sit and look for a better entry point? So that's part of the reason that I like having a little bit of something on ahead of the Fed, is because it helps me get into the right frame of mind of, okay, I had a little bit of bull stuff on, it's working. And if let's say I'm long and out of the money call, as the market rallies, out of the money calls increase in delta, which means I'm increasing my long exposure. So my position puts me longer the market, which means that I can either still manage that by taking some profits, reduce my exposure, or I'm naturally getting longer, so I don't have to go out and buy more because I've got something on and I'm getting longer delta. So I have more exposure already based upon my position. If I do a put credit spread, I start off a little bit long, and if the market's rallying, my delta decreases. So I'm actually naturally reducing my length in the market. And I may naturally want to reduce my position as well because my put credit spreads are working, and now they may not have a big return on capital potential. I may have already achieved it. So, depending upon the way that a market or a position is built, I think it's built upon the idea of how do I want to have my position react into this market? Do I want to become less long if we have a bullish reaction? Do I want to become more long if we have a bullish reaction? If I want the latter, I need to be buying calls. If I want the former, I would want to be selling put credit spreads. And if I want to have a hedge to my position so that I can buy a dip, I need to be long the market with puts or just long puts. But if we go up and I'm long puts, and that's my only position, I'm losing, I'm becoming less long because my delta's decreasing. And am I ready to flip the switch to being bullish and start buying the market and start playing for continuation? And again, if I get 2%, is that now chase or is that continuation? It's the difficulty of these inputs, long and short, right? So if I truly believe in an individual company right now, I can also look at adding more time and say, okay, I really like Pinduoduo, Temu, whatever, for some reason. Now, I don't know if the Fed's going to have an impact on Pinduoduo that may or may not be logical. So I don't want to be in options for Pinduoduo if I have a long-term bull thesis based upon, I don't want to be long this week's options for Pinduoduo. If I think that my thesis is that the market could either go up 2% or down 2% tomorrow, tonight, I can trade that with options in the short term as I'm trading the event. I think that at the end of the year, we're going to be up 6% from here. Then I want to look longer term and say I match my time frame of my options with my time frame of my thesis. My view is that we're going to get 6% before the end of the year, and I don't want to have the exposure of the Fed, and we get 3% today, then I may not be looking to buy the market tomorrow because now we've gotten half of my return already. I only got 3% left. Do I really want to be aggressively adding into a market that I'm expecting 3% in 3.5 months? Maybe not. That's more of a traditional return at that point anyway. All right, so we still have to be aware of earnings dates, although there's not that many interesting this week. We do have FedEx. That's kind of the one now, I guess, that's might be interesting. And FedEx is an interesting barometer for market confidence in the U.S. economy. You know, when we're shipping, that usually means that there's a lot of commerce going on, and so, you know, that could be a sign of a strong economy. But again, the main driver for the next few hours is the Fed, which acts almost like earnings for the whole market because they can have an impact on people's expectations of future economic growth for individual companies as well as the whole economy. What I got there. So let's go into the 10-year yield, unchanged today, near the lows. We're setting this a little bit of a range for now, 4 to 410. Fed today can shift it. They say something that is a little bit less indicative of more future rate cuts, and we may jump back up about 410. They make a strong point that they want to get aggressive with rate cuts, and we may get down lower. We'll see. If we go lower, does that start to change the market? Behavior certainly is going to shift what sectors people are looking at. Lower interest rates, cheaper debt. Maybe we go into growth, go into tech, go into biotech. Biotech tends to do well with a low interest rate environment because they tend to need to raise capital. If we see higher interest rates, maybe it can be better suited for other sectors. Maybe it's better for financials because they tend to get a little bit more of a spread on interest rates with a little bit higher, but maybe not for like a Wells Fargo, which is going to be more based upon getting mortgage growth. Low interest rates can be better for home builders, yada, yada. So, we kind of look through some of those sectors today and see if there's some opportunities coming up based upon the current technicals as well as the market structure. I mentioned this yesterday. Market was going higher or consolidating, and yet MMFI has been drifting lower. So in this bull market, there's less and less participation. Heavy focus on some of these names that have been just chased to extremes. Whether it's Baidu or Micron or Tesla. These are names that have just been on a tear. And meanwhile, we have NVDA weak, and actually had some news about China looking to basically say that China shouldn't be buying NVIDIA chips. Maybe that impacts the tariff negotiations. So individual names are moving right now. It's not a broad buy everything market. It's still a stock picker's market. Heading into a Fed announcement, kind of a difficult spot to be in. Do I want to chase those winners and participate in the Tesla run, or do I want to wait for the Fed at this point? because I can get caught on the wrong side. If I go aggressive with these chase trades and the market says bearish because of the Fed, some of those chase trades can have turn around on a dime. People just trying to take them off before they flip from a 90 or an 85 RSI back down to the middle of the previous range and have big potential for downside as a result. That's the micro concern for me. They're already chase trades. They're working. I don't like chase trades. So I don't want to chase those right now unless I have a very, very quick stop, which can be hard because with those stocks that are going up like that, we can have a dip of multiple percent that doesn't negate the bull thesis. But if I just put my stop too low, I get in trouble. I take a big loss for something that was built upon something other than what's going on with that individual company right now. It's built upon the broad market and the Fed, the reaction to the Fed. Bitcoin. So there is some signs of risk on here for Bitcoin. We are down a little bit today, bumped up against 117 and then faded. So 117 was generally the low part of the range here in late July. And we're trying to get back into that range of 117 to 120. After the Fed, I think we'll either get there or we won't. And if we don't, we have risk down to 110. Back down to the 100-day moving average, back down to the lows of the previous range. We did briefly dip below 110 for a couple of days around non-farm payrolls. But generally, it was non-farm payrolls. That was the 5th. So heading into non-farm payrolls had a little bit of risk off at the beginning of the month, but then been grinding higher since. So there's been a tolerance for risk, but it's been very stock specific. Long and short of it, right? All right, S&P 500, a complete unchanged. We are down 3 cents today, now 5 cents, now 2 cents. Unchanged day. Yesterday, I noted we had a higher high and a lower low. The high on Monday was 661.04. The high yesterday was 661.78. The low was 659.34, and yesterday's low was 659.21. Right now, we're still inside of Monday's range. Today's low is slightly higher than yesterday's low. Really, there's nothing, right? Anything that we get ahead of the Fed, not driven by leaked out information that the Fed's going to say, is noise. It is the chop. It is the risk reduction from some just position management as opposed to true investment plan. So risk reduction, small risk on, small risk off, heading into it. More likely we're going to see a little bit of risk off than risk on because we're at the highs. So more people should be long the market given that we're at highs. So the risk reduction would be driven generally by reducing positioning or hedging. We have the VIX over 16 right now ahead of this. People have been a little bit more aggressive buying puts the last few days. We had the VIX get down to 14.4 on September 12th, and it's now up to 16.1, whatever, up 2%. So people have wanted to reduce risk by hedging instead of just selling the market. So it's buy stock, buy puts. SQDEX had been coming up a little bit. Right now it's down slightly today. Kind of looks more like maybe people are buying put debit spreads, rolling up some puts, getting them a little bit closer to market, and selling some calls. So buying a put spread and selling a call would cap my upside, take advantage of a little bit of elevated volatility, and it finances my hedge. And if the market starts to run and I'm short calls against my position and I don't want to be called away, and then I'm going to have to switch my mode, start covering those calls, rolling them up and out. We're just taking them off. And that can create a positive delta impact for the market if people have to aggressively buy calls into a rally. I will note that skew is not particularly high here. This is calls versus puts. So generally, calls have stayed somewhat elevated. More of the action seems to be driven by buying puts rather than by buying puts and selling calls. So I would not be surprised to see some call selling today. But as we got into that breakout mode, the aggressive buy right, it hasn't come in yet. So people have not been willing to cap their upside aggressively. They've been willing to buy puts more aggressively. So if the Fed comes back out with something neutral to slightly bearish, we may see some slightly bearish, we may see some call selling because it puts a little cap on the market. We see aggressively bearish, we may see just a lot more management of hedges and determination of whether the dip is enough to justify buying yet. And that's going to be again, the big question mark. How big of a dip is needed to be the dip to buy? Because historically we've seen it over the last few months. Every dip has been a buying opportunity. And we get shallower and shallower dips. We get down to 626, then we only do 633, then 635, and then really not much of a dip here after trying to break out, and then a new breakout. So these dips getting shallower and shallower, higher and higher lows, with higher and higher highs, but in a choppy bull market. Maybe the Fed can fix that and make it a just true bull market instead of a choppy bull market. It's an easier market to trade. Choppy bull markets can be difficult. Natural inclination, sell a new high so that I can buy the dip. And then I have to be more and more aggressive with my dip buying because I didn't really want to be out of the market. I just didn't really want to take that 2%, 3% drop. Not in a market that's only giving me a couple of percent every few months. And the new high has been so lightly new high. So again, maybe the Fed shifts the tone of the market here into a more, less choppy bull market and just more of a pure bull market. We will see. To the note of just noting real quick, to the note of like gold being down a little bit, you know, Tesla's down a little bit today too. Gold down $1 today. It's not particularly meaningful, but we were at the highs yesterday. Silver down 50 cents. We were at the highs yesterday. So just getting a little bit of profit taking here, not eliminating the bull thesis, but you know, people that bought for the last few days, Friday, Monday, Tuesday, are now down money. So buying into that chase looked pretty good on the open yesterday, but by the open today, it looks a little bit weak. Again, after the Fed, we'll get some clarity on this. So silver and gold also, just as a note, the futures markets, the official close is pre-Fed. Now the ETFs have a lot of volume. Gold and silver continue to actively trade after the official close. So they should still have some good volume, good potential for movement, though, as well. There should be a little bit less liquidity than there would be in the morning because of the pit closing and the official close already occurring. But we may see some choppy behavior in gold and silver, particularly given the run that they've had here over the last few weeks. All right, small caps up 1.5 points today, up 0.6%. So more of the same for small caps. Kind of the opposite of the market where we've been getting big up days and then consolidation drift down, then bigger up days, and then consolidation drift down, then bigger up day, then consolidation drift down, continuing to find support at the 10, not the 20-day moving average, but generally the 10-day moving average. We'll see if that, again, comes through the same today where we get a potential spike off the Fed, or if this is the end of that choppy, very choppy bull market. These are harder even to buy into than what we've seen in SPY, where we've seen drift up and then drop to buy. The spike days, you know, you're either on it for that one day and then taking your profits and then waiting to see if you can time out the next spike day versus, you know, participating maybe on days 2 through 4 of the rally and then hoping to be out for the one-day drop. And if not, saying, well, as long as I had some cash, I can still allocate. IWM, all the return happens on a day, and then it's all about profiting for the next 3-4 days until we get the next spike. And then having to know when to buy onto that dip. Well, okay, I guess it's buy the 3rd day of a dip. That's been what's working. Yesterday was day 3 after the new high. Post-Fed, we'll see if that pattern continues. Within small caps, I generally watch XLF, 3 days of dip, today a buy day, KRE, a little bit longer dip and a little bit more meaningful here. So a little bit more of a safe version of financial asset allocation here. You know, stocks like Morgan Stanley have broken out last week. Goldman broke out last week. JP Morgan broke out last week. So these big financial institutions broke out last week and look a little bit more like SPY than IWM or XLF, versus, like now Zion chopping couldn't really get a breakout, or Wells Fargo, which surprises me, honestly. I thought that should be better. But to the same note, like, PHM, Pulte Home, that's had a bigger drop here. XHB has had a little bit of a bigger drop here, more like a KRE style drop. Maybe found support here, lower interest rates, good mortgage origination, things of that nature should generally be good for home builders, but we'll see if that shifts today. And if we go bullish here, I do like going over to PHM. It was on our weekly power trader list, looking for a new high. So if we've got everything with some good confidence here and home builders start to look good, again, there's two avenues, either looking for a put credit spread with PHM, going out next week. There's not a lot of premium in a 132, 131 put credit spread, but 30 cents is a pretty good put credit spread for PHM. Don't have earnings or anything next week. That would be a good avenue. If we start to run a little bit more, then I go over to the call vertical in October, 140, 145. Looking for that new high. Previous high right now is 142, just under. So 140, 145 is just under $2. If all we can do over the next month is get back to that previous high, it's a break even. If we can do more, then I can get some real return there. So kind of watch the tone of the Fed, watch the words. The decision ultimately would probably be tomorrow morning, not this afternoon. We should have some input right before the bell, but the general gist for me would be looking for those bigger structural type trades tomorrow morning, and I may miss some stuff. But if I want to go for something this afternoon, I think staying with the big ETFs, SPY, IWM, and QQQ has a lot of logic to it, and then getting into individual names in the morning. So if I want to trade some of the initial reaction to the Fed, I stay big, and then I go down from the big ETFs down into the individual names in the next day or two after that. XLV, since we're on the IWM stuff, chopping and consolidating near the highs. See if that has something interesting after the Fed. Just watching to see if that gets below 136 or back above 139 above the 200-day moving average. And XLE. Oil companies have started to look strong here, testing the highs above 91, and XLE sets up an interesting bull breakout. XOP, very similar, above 135, 136 range. And we're real close to those. So again, as usual, I'm going to watch USO for that. If oil starts to run up, if the dollar tends to look weak post-Fed, these can be inputs that can set up another commodity trade instead of just gold and silver that have been working. Maybe the oil trade and the oil companies come with that. And then, of course, tech has generally been looking better here heading into the Fed. Yesterday did not make a lower low, did make a higher high. We're going to be towing right at the highs ahead of the Fed. SMH has been giving a good leading indication here of bullishness, doing the same thing. So when I see semiconductors good, that's usually a good sign for tech. I've seen tech good too. So the one that isn't right now is NVDA. So the news about China saying we shouldn't be using NVIDIA chips, having a negative impact here. Maybe a short-lived concern, maybe that gets worked out. But for now, as much as I liked NVIDIA yesterday, now with the news, I'm not so sure about NVIDIA. We got to see how this plays out, and maybe I avoid NVIDIA from a semiconductor standpoint and focus on those that are working like AVGL, Broadcom. A little easier to get into Broadcom, it feels like, although it's weak today, than it is for me to get into like a Micron, which has just been on a tear, and it's working to continue to chase in here. But now we're finally getting some consolidation, but we have an 83 RSI. Hard to buy an 83 RSI stock without feeling like a chase, especially after running, 25% or more, nearly 30% here in the last week and a half. Speaking of chases, we got IONQ. Again, they've got their own individual fundamental reasons why they're running. 83 RSI. Again, feels like a chase. I do have this thought that other quantum companies like Quantum, QUBT should have a follow through if IONQ keeps going. Testing the highs here. This is one for me to watch as an individual name. Again, not necessarily pre-Fed, because if we do get liquidation of risk, Quantum doesn't do well in that scenario. But I like QUBT for that potential upside. And it doesn't feel as dangerous as buying into IONQ, because the downside for me on QUBT be down towards like 15.5, still 10%. IONQ, if we go risk off, feels like it should have downside risk maybe down to, even conservative like 50, 20% more. So more risk in IONQ than in QUBT, but it is working already. QUBT has maybe 10% risk, IONQ has maybe 20% risk, same implied volatility. Which one has the bigger upside right now? QUBT looks like it could have a good spike to 20 or 21, and then set a price target for me to look to exit, and that feels like an easier trade. All right. So yeah, let's see. Today's sectors that are moving right now, it's K-Web, which is back to China. FXI, again, another 1.5% there. Asia is generally working right now. Taiwan up another, well, it's only 8 cents, but it is a new high, I believe. Yesterday's high, 63.46, right at the high. Towed the same high, same level today. TSM, big part of EWT. It's like 22-23% of EWT. So keep that in mind, that the EWT is very driven by Taiwan Semiconductors. Sorry. Yeah. Another sector that's moving this morning, XLP. So consumer staples getting a little bounce back after testing support at 79.5. So we've got a line in the sand here, 79.5. Every time we test it, we bounce back off. 82.5 would be a general price target here, $2. It's low implied volatility ETF. Couple of ways to trade this. Again, probably waiting to see what the Fed does first. But a 79.5, 78.5 put credit spread's 24 cents. So a way to get some decent return on a low volatility ETF, as long as the market's not pure liquidation. So if staples are going to hold up after the Fed, that's a spot that I think makes a lot of sense. XLP 79.5, 78.5 put credit spread, rather than going for a call vertical and adding a little bit more time just to target 82. I don't get a huge return on that. I don't get a meaningful return. I actually feel like I get a better return just selling the put credit spread, instead of where I really get a return here for the next month is if I think that this can go to 84 or more. FX, I already mentioned. XLU bouncing back. So noted yesterday, we were talking about how utilities didn't seem like logically they should have been down quite as much yesterday, and they are getting a little bounce back today. That drives me into NEE as a potential idea here. A little more upside, little higher implied volatility than XLP, but we're looking at that potential for 10 or 11% to get back to highs, versus XLP is only 2.5% away. So this actually does drive into a potential for a call debit spread instead of a put credit spread if utilities look good post Fed. I like NEE. It has its line in the sand here as well, around 69. And sets up for a call debit spread if and when we actually decide to go up more meaningfully. Along with the other stuff in China and Taiwan, EEM, another strong one today. This is now we're getting into under one standard deviation moves though. So a nice, pretty normal move here for EEM. EWY, which has been on a tear, is pulling back a little bit today, but finding buyers already. So South Korea, which has been pushing a 75 RSI, is still getting money flow. You can actually see it's happening with pretty good volume too. Good volume on last Thursday, good volume yesterday on this buying action. People are going into East Asia for their money flow. India is back on the tear a bit again today too. So for those looking for stuff outside of America, maybe a little bit less exposed to some of the Fed behavior other than maybe the dollar reaction. Asian markets right now are looking strong. So keep the, keep looking at those if you're interested in the Asian markets. Baidu, another ridiculous day. Baba having a good day again as well. We've been looking at JD. Looks like it's ready, but it already picked up another $1 today. My upside target is only 238. It's still 8%, but it's not nearly the return anymore because we pulled up way 2.5% of it already today. So, this is that difficulty in some of these markets right now where we get quick moves. Normal 1 standard deviation day for JD is 3%. We moved a standard deviation today. Do I want to buy up a standard deviation? Well, if it's going to mimic what happened with Baidu, then yes. If it's just the last one getting bought and this whole buying everything in China story is over, then no. That's the decision I have to make is the China buying done? Is there going to be a real material pullback in Baidu to even 115? Doesn't feel like that bad. That would put us back to the levels from Monday. And yet that is, 15%. Just to take away 2 days. Pinduoduo, Temu. That's been a little bit more of a normal bull market here, overbought within the bull trend. So the bull trend, the trend line, we've tried getting through it a few times, but you can see we get this like trend channel here where the upper side is around here. The norm would have been around 131.5 here, up to 135. Are we setting up a more accelerated bull market, or is this just like the last couple times where we jump through it and then a couple days later pull back to the 20-day moving average? I would be more inclined to say wait for the pullback to the 20-day moving average at 125 and enter there. If I'm long because of the trend, it's a great spot to take profits. I don't necessarily want to go short, but I do want to wait. If I'm not long, I'm not buying. 2-3 days of staying above and continuing, maybe it just shifts us into a more bullish market. In that case, I'm probably looking at something else. But if I wanted to look for Pinduoduo, I'm waiting for a dip to buy that. All right. Real quick note, General Mills had their earnings this morning and didn't do anything. Mentioned yesterday, it wasn't that interesting for an earnings trade other than maybe doing a iron condor for a credit, selling the 47.5, 45 put credit spread and selling the 52.5, 55 call credit spread. That was the right thought process, but it wasn't enough leverage or return really to make it a trade that I was particularly interested in. It turns out it would have worked, but whatever. Right? Nothing moved here. Finding its support, down very small on earnings. I don't normally like selling put credit spreads and downtrends like this. If it starts to shift bullish here and gets back above 51 and make trigger a potential interest on a bullish trend type trade. But for now, I don't see anything major there. So the weekly power trader names we've got this week, again, actually starting to look a little bit like the Corning, GLW, Micron, and Tesla from last week. We got Caterpillar breaking out today, pre-Fed. HD came up on aggressive power trader as well today, breaking out or testing a breakout here. So the previous high was 4.25. Right now we're right on the nose on that. We've had a bull run here and then some consolidation for the last couple of weeks. We've got good support at about 412.5. I don't like selling the put credits, but necessarily in HD down at 412.5. That's 412.5, 410 put credit spread is about 45 cents. So it's about a 20% return on risk. So it's not bad. It's okay. That could be good post-Fed if the pricing stays around there. If we get into breakout mode, just a call debit spread, close to at the money, selling a 30 delta call is usually my target in a trending stock. So it's like 4.25, 435 to 4.25, 440, and just riding the wave at that point on a breakout. Meta consolidating near the highs, waiting for the breakout. Same kind of thought, we could use a 730 level as support, or even more aggressive and use the 50-day moving average, which is right now 745. That's a bit more aggressive. Again, I need Fed to not derail the tech bullishness for that to be a good trade. So biggest concern would be if the Fed says something that gets tech money flow to go the wrong way, and then I can get in trouble with it. So generally thinking avoid the tech stuff too much pre-Fed. Micron, I already said I'm scared of Micron. You guys may be able to make money in it. I don't have the confidence in that trade to put it on because I would be too jittery if it started to pull back. So I'd want to set a stop around 130. Around 130. That's more risk than I would normally want to take in Micron. I don't want to sell put credit spread all the way down there. So I know psychologically I'd want to be out by 148. That's also still 6%. I don't want to take that risk setup for myself. I just feel like I would get myself out too early on a dip or too late if it's actually a break. So I don't feel good about Micron for my trading stock. Already mentioned PHM. I think this is a good potential setup with a call debit spread here for retest of the highs. For the put credit spread idea would be like a 130, 129, go down to 130, where we've used as some support before the last breakout. So 130 would be my level on a put credit spread. Can generate some decent return there. 130, 129 is 24 cents. So about a 30% return on risk. That's a decent return in a home builder stock. Again, home builders, I think, can be very reactive to the Fed if they make any impact on mortgage rates. So something to definitely be aware of, but at the same point, post-Fed, I think it could be an interesting one. And then WDC. Western Digital, it was on a nice bull run. This is the question mark for what I was saying with like PDD, where we've had a nice run. We tried to break out and then consolidated on earnings. This time when we broke out, we got follow through and turned into a chase trade. We got up to yesterday a 90 RSI, today an 82 RSI. It's so overbought that I'm afraid to buy into it. So much like Micron, I feel like that's one that if I was in, I'd be out. I'm not in. I don't want to get in. So not my style for that one. I should note that HD, I don't know if I mentioned, but that was part of the aggressive power trader as well today. So HD is an interesting one, but it does also still have some correlation to home builders and interest rates as a result, or construction stuff. All right. Got other stuff that's moving today. I didn't see the news on Workday, but Workday is up 9% today and testing the highs of the range. I don't see the news there. I'd have to look that one up. But, all right. No, nothing major to trade off of that. Lyft up and Uber down. So they got the partnership with Waymo. Uber's got the doesn't have the partnership with Waymo. So now with Uber, we just got a range here, right? 100-day moving average is support, 100 is resistance. Iron Condor candidate for those that are looking for just something neutral. 100-day moving average right now is 80, we'll call it 90. So 90 to 100 range. I could look at it for next week and just try to collect 23 cents for the 90.89 put credit spread. 101 at 12 cents on its own. Probably not enough premium. The put credit spread is the better part of it, but 101 also looks like a way to add a little bit of extra premium. I don't see us going above 100 here in the next week and a half. given the news. Probably actually a better trading opportunity, frankly, than Lyft. Because Lyft, now we're in this, again, 82 RSI, is it got continuation? It already had a run up ahead of this Waymo announcement. And now are we priced in and now just digesting and then potential for pullback? A bull flag would be a type of setup that would be more interesting, I think, in Lyft, where we get 3-4 days down and then start to show some upside, then add in, get that RSI down before going in there. If anybody's long Lyft, again, this is the spot where I just taking the profits and moving on and saying, all right, find the next trade. All right. Oh, you said you lost audio. Can you hear me now, Fred? Anybody hear me? Or if anybody can just throw in I can hear you on the questions or the chat to let me know if it's back. Indication that I may have lost audio for a second there. Fine. Okay, good. Thank you, Mario. All right. So looks good now on the audio. Perfect. A few others saying good on audio. So hopefully it was just a short-term blip there. Already mentioned Baidu. QBTS is running today. So this goes back to my QUBT thought. QBTS is kind of, it looks like one of the second ones here. So IONQ did the run. Yes, running. Is Rigetti running? Rigetti is running. So either QUBT is just a bad company, or they may be the next shoe to drop there. Gives me more and more intrigue there. And frankly, probably should wait till after the Fed, but let's see what the implied volatility can go to 120% in a bullish mode here. I've been taking a small position here. More lottery ticket style would be like a next week 18.5 call for 60 cents, or go out to October the 20s for $1. And yes, I get it. 20 is kind of my resistance point, 20 to 21 range. So I need to see that spike and that increase in implied volatility. But the reason that I like going into the out of the money calls in October is not because I'm expecting it to necessarily go to 30. It's because I expect to see implied volatility rise into a rally. So if implied volatility rises 20% and I'm long calls, I get a Vega kicker on top of the delta benefit of a rally of $3 to $4 here. Gosh, that one's really tempting right now. I would not do a call vertical. So right now, the market's basically saying that if we go to 20, this implied volatility goes to 100. I don't think that's pricing it enough. I think we should be looking at 115 to 120. If implied volatility rises that 15 to 20%, it gives me an extra 30 to 40 cents in the options, effectively 30 to 40% return just on Vega. The delta would be an incremental $1 roughly, you know, a $3 rally. And then these are priced similar to the 17s right now. So they go from $1 to $2, then increase the Vega and they can be $2.50 to $3. So this is one of those spots where QUBT could actually be a very big leveraged return if all quantum stocks join this party. And it doesn't always happen. I mean, we saw it with crypto-related stocks. You know, Hut 8 went on a tear. Marathon didn't. You know, Riot did. So maybe QUBT is just another marathon. Not going to go down necessarily with everything else going up, but it never really got caught into a bull market here. I think Bob had mentioned before, Block. That was looking really good for the crypto stuff. And a little bit more of a normal rally as opposed to the kind of crazy stuff that we saw in Hut 8 or BTDR. It's been a little choppier. Hut 8 for has been like the big winner there, going from 22 to 35, up whatever 60% in a month. That's the, you know, IONQ apparently. Last real sector for me right now that I wanted to just come back on is Jets. Seem to have found support near where we were before. Delta had been a little weak. and bounced off the 50-day moving average for now. United just feels a little safer right now. So Delta looked better to me for the potential for upside. Now that we've gotten into this mode, I think United is the safer put credit spread. For United, I just go out and look at like 100 or 199 put credit spread. $100. It's a decent line in the sand. We did dip below it briefly, but 100 is usually a big number as well. It's below where we've been trading recently. It gives me some confidence there. And so I do like UAL for a put credit spread as a potential opportunity in the coming days, more so than Delta. Delta just had that negative reaction off of their earnings projections and their bookings on September 11th. Followed through with that dip down. They did have good earnings on July 10th, but it feels a little bit easier to go with United right now, even though Delta kind of tempted to say 57.5 could be a line in the sand. UAL, I would just go down to 199. I just like the 100 level. It gives me a little bit of room below the lows, and there's enough premium on 199 put credit spread. 20 cents, so 25% return on risk. Risking 80 to make 20. That's the normal kind of setup I like with a put credit spread is, that 20 cents for $1 wide or 50 cents for a $2.50 wide put credit spread. Just, and then that seems like a pretty big ask to get United back below 100 after finding support here at briefly at 102 yesterday. Let's see, GLD. Yeah, GLD holding up, so a little bit of buying, so it was overnight selling, I guess, and then market buying during the day. Silver bouncing back up a little bit here. USO backed unchanged, so little dip in oil. It's got bought back up, so some money flow going into commodities here. Dollar's not moving today. Dollar's been weak though. For DXY, it's getting real close to that July 1st low. I know UEP is a little higher, but DXY is getting close to that July 1st low. And again, we may see something wild if the dollar dips on the Fed this afternoon. If we break that level, the July 1st level in DXY, that can create some real bullishness for precious metals as well as for Bitcoin. We'll see, right? What could versus what will, we'll see. I want to pull this up because I see it moving again. One of those stocks that I've checked on a few times over the years. It got caught up in the Reddit buying back in 2021, the GameStop stuff. And when the market starts to get close to that point of being near a top, we tend to see buying in Plug, AMC. Still see a little bit of in GME, and that's been running a little bit after earnings. And this is alternative energy as well. So if oil is firm, maybe there is something about there. I think it's hydrogen. Hydrogen fuel cells. Yeah, hydrogen fuel cells. It just could be an interesting stock trade. The options do trade, but trading options in a $2 stock can be a frustrating way to trade in general. I mean, you're usually looking at a very high volatility and a high percentage of the stock price, paying 10% of the stock price to buy the calls expiring on October 24th instead of just buying the stock. Usually I think that these are just better suited for stock, unless I'm wanting the lottery ticket in case it goes to 20 bucks, in which case, I can go out to January 5s and buy a couple of lottery tickets and try to forget about them and just hope that it comes through. Reddit, yeah, let's take a look at Reddit. Testing the dip back to the 10-day moving average. Let's go back to see if there's it's an NA model grade. Slight bullish, but NA model grade. So this is the dip point that we've seen for the last week after the breakout. So previous resistance around 250 is now becoming support. data here. Okay. There it comes. It's a lot of juice. Previous high was just above, like around 249, 250 range. It's a good amount of premium though. How about for this week even? It's a lot of premium. 70 cents for the 245, 242.5 put credit spread for this week. I get it. We could drop there tomorrow. I mean, the average normal expected move is about 4%. Realized has been closer to 3.5. 4% would put us below 245. So that's right at one standard deviation. But it gives me 70 cents. So risking $1.80 to make 70 and saying that we're not going to dip back below the previous high. So the thesis would be, for me, I think we hold above 245, but there's a chance that we go all the way back down to the 20-day moving average, which is 235. It's 235 per credit spread for next week. That's a higher probability, and at 60 cents, that's also pretty good. I mean, basically a 30% return on risk for a lot higher confidence. That's probably better. As much as I would love to get a little extra premium and go out for like a near dollar on the 245, 242.5. I think next week 235, 232.5, 60 cents, 30% return on risk, and we just have to hold above the 20-day moving average instead of having to hold above the previous high. And I get a little nervous if we get below 245, touching 250. You know, a little hesitant, but below 245 is where I start to get nervous there. It was the paid trade yesterday. I'll have to double check Fred on the text alert because I know I got one. Double check your settings on the text alerts. So yeah, that's still looking good. One of the things I had mentioned yesterday with EWT that's interesting is the October implied volatility is 20. It's the lowest on the board. Now 22% of EWT is TSM. And TSM's highest implied volatility is October. So maybe a little bit of a market opportunity there where, yeah, I get it. There's, 75% of it, roughly 3/4 of EWT is not TSM, but they're all also very correlated to TSM. So I would normally have expected EWT implied volatility for October to be closer to 22% to line up with TSM. Markets are a little wide this morning, but that's generally been in line. Not a ton of volume here in EWT though, to be fair. Then that may be part of it. If this position right here was somebody selling those, the market makers are long, so they keep this at a deflated level and implied volatility until somebody starts to buy these options from them. So that would be my best guess as to why the implied volatility has stayed a little lower there. But EWT looking good still. Not as good today as FXI or KWeb, but generally seeing that money flow into Asia and in INTA today, about 0.5% now in India. So we're seeing Asian money flow right now. People like that going out to the Far East. So EWT still riding along, which is good. Good to see that plugging along for now, and we'll see if that continues. So, all right, guys. Any other stocks to take a quick look at here before I let you go for the day? And a lot of this is just for me preparation for what to do after the Fed. Again, if I feel like I'm too long right now heading into the Fed, then I probably am. Right, and after the Fed, I will either feel like I was too long or too short. Right, it's the natural reaction. If we go up, I wasn't long enough. If we go down, I was too long. So I try to find that balance point of how I'm going to feel if we dip, and I'm okay with that, good. If we rally and I didn't feel like I had enough, then maybe I can add a little bit more just with some, short-term out of the money calls just to give me a little kick, or something that made me a little bit more safe going into the Fed announcement itself. But otherwise, just kind of have my list, whether it's in the Pulte Home or, Reddit. I actually think that put credit spread looks pretty good, but there's a question maybe about tech performance post Fed. Some of those energy type names if we see a weakness of the dollar. All right. Oh, and Uber for a put credit spread, even though they're down today. So looking at a couple of those type of names. All right, guys. And with that, I'm going to let you guys go. I'll be back on for the morning bell tomorrow. Vlad should be on for the close today to talk through some of the initial stuff that's coming through from the Fed here in the afternoon. So buckle up. I hope everybody feels prepared, and if you feel good, then that's a good spot to be in. And if you feel nervous, then make sure you fix that. You got a few hours to do so. So, all right. Thanks again, everyone. Have a good trading day.